Hello, my name is Michael Swanson. I run the website wallstreetwindow.com, and I run a private group for high net worth investors called Power Investor. I want to give you a stock market update for August because I believe the stock market is actually at a critical tipping point that's going to lead to a big drop in this coming month. Now, let's think about July. The S&P 500 went up about 2% for the month. The Dow finished down about 80 points or so, while the NASDAQ was up about 100 points. It doesn't sound like a lot's going on there. And if you turn on your TV on one of the financial channels, what you're going to see are people recommending you stocks. They're going to tell you to buy this stock or that stock. And in the evening, after the close, what you'll see is they'll talk a lot about the 2 or 3 stocks that went up a whole lot in any given day, but what they won't do is tell you about what's going on in the rest of the stock market. And that's what's important, because you see, even though the market averages are kind of mixed there, most stocks actually declined during July. And some stocks were down quite a lot during the month. And that has critical ramifications for what is going to happen in the stock market this month. Let me show you what I'm talking about. Almost 6 out of 10 stocks on the New York Stock Exchange are now trading below their 200-day moving averages. At the same time, over half of the stocks on the NASDAQ are also below their 200-day moving averages. This is really bad. The reason why is that bull markets come to an end when only a few stocks are still going up and almost everything else no longer is going up when the averages are. And that is now happening. And the last time we had such poor internal action in the stock market like this was back in October of 2007, right before the beginning of the last bear market. And what happened this past July is that only a few stocks went up over the course of the month. These stocks were about 20 of the NASDAQ 100 stocks that are really popular names. And the problem with these stocks is that almost every single one of them also made a top just a few weeks ago and are now ready to drop even more. For example, let's take a look at Google. Google gapped up in July when it reported earnings. In fact, it was a crazy gap up. And ever since that gap up day, Google has been slowly trending down. Anyone that bought the news on the open of that gap up day is now losing money. And Google is not in a position to go up to new highs anytime soon. At best, it will pause here for a few weeks, and it's likely to just continue to drop. And the same thing happened to Amazon. And other tech stocks that were big leaders earlier this year just went down this month after they're reporting earnings. In fact, that's even what Apple did. Even Apple! Apple, in fact, is right now sitting on its 200-day moving average. It's sitting on a support level. And if it breaks that support level, it's likely to fall even more. For example, look at what stocks such as Intel are now doing. It looks terrible. And most semiconductor stocks look like this, or worse. And look at Exxon. It's also trading right on its low of the year. And look at the XLE ETF that tracks energy stocks. It's getting ready for a big dump. In fact, energy stocks made a big bottom last Monday, tried to bounce, failed to bounce, fell back down towards that bottom on high volume. That is a dangerous setup for energy stocks. And a lot of stocks in the stock market look exactly like that. There's actually a lot of carnage now going on inside the stock market when it comes to individual stocks. If you've got a portfolio with like 50 stocks in it or even 30 stocks, you've probably noticed that almost all of them are now dropping. But most people really don't see this happening if they don't own lots of stocks. They just own ETFs. That's because of two things. First of all, of course, the stock market averages have not yet really started to drop. And television is just full of hype and doesn't talk about what's really happening inside the stock market. What's going to happen though is the averages will follow what's happened with the rest of the market, as the few stocks that have done well, and I think have topped out already in July, start to really drop. That will push the averages down, and they'll catch up with what's happened with the stock market as a whole. Now, there's a couple implications to this for both of us. First of all, as investors, and I assume you have long-term investments in the stock market, this means we face a coming bear market in the stock market. The situation now is identical to the setup that happened in October 2007. Now, I'm not saying the stock market is going to crash like it did in 2008, or banks are going under, or anything like that. Bear markets are part of market cycles. The average bear market lasts about drop for about 35% over 15 months. Now, you can reposition yourself in your core investment portfolios and take a defensive stance to protect yourself from such a move, even to make a little bit of profit. However, if you are someone that does trading in the market, you can also take an offensive stance, take an offensive playbook to adapt and to adjust to these changing market conditions. A year ago, you could have bought stocks that were breaking out to new highs, bought stocks on dips, used just about any strategy between 2012 and the end of last year, and made money in the financial markets because the market was going up at a 45-degree angle in which every single dip was a buying opportunity. But now that environment is changing. In fact, that environment is over because those strategies are no longer working. For example, the breakout strategy of buying stocks and they just made a new 52-week high now has been failing for months, has not worked for months because things have been making fake breakouts and coming back down. You know that if you tried to buy semiconductor stocks, the SMH ETF back in May when it broke out to a new 52-week high, biotechs have done it. Almost everything that's broken out this year has done it. So if you've been losing money on such strategies, if you continue to do them now, you will compound your losses. However, if you adapt, if you adjust to these new market conditions, I believe you can put yourself in a position to start to make profits and really to start to rack up profits. And the solution is very simple. It is to start to bet against stocks and bet against stocks that are in a position to really dump as the market drops or to continue their vicious downtrends that they're already in. Let me show you 5 examples of 5 troubled stocks that I believe are going to decline in August and provide an excellent profit opportunity if you decide to bet against them. This is a chart of oil giant ConocoPhillips. It's in big trouble. As you can see, it barely is holding its last low set on Monday and is experiencing huge selling volume. You could bet against this stock by purchasing a November put option with a $50 strike price. That put option closed Friday at a price of $2.85. It's $2.85 per share. Now, if COP shares fall below 50, as I think they will, this option will explode in value. Now look at this stock. This is an oil and gas drilling name of Encana. It was a high flyer a year ago, and it made 15 cents a share a year ago. But in its last quarterly's earnings report, it lost 20 cents a share. Analysts were expecting it to lose money, but nowhere near as this much money. And that's what's going on across the entire energy sector. A lot of these fracking companies, a lot of these oil companies need higher oil prices to make a profit. and oil prices are not going to go back up to those levels this year. That means the losses are going to pile up, and analysts have not even adjusted their estimates to match that reality. It means more write-offs for these companies. That means more losses for these companies. That means more stock price drops for these companies. And this stock here is a disaster. You could short it and put a stop loss on it above $9. Or you could buy an in-the-money October put option with a strike price of $7. That option last traded at 85 cents on Friday. Okay, let's get out of the oil patch. Now look at this stock. This is Skyworks. It's a high-flying semiconductor stock. In bull markets, it tends to go up like mad and reach a crazy bubble top and then totally fall into oblivion in bear markets. This is what it did the last two times. It's poised to do it again. Remember how semiconductor stocks such as Intel are now lagging the stock market and are set up to dump. Well, Skyworks is set up to really dump because it's trading with a P ratio of 25 and it's 6 times book value. And I think the analyst estimates in it are way too rosy. You could short it, or you could buy November put options for Skyworks with a strike price of $95. Those puts at $95 last trade on Friday for $8.45. Okay, now look at IDTI. It's another semiconductor stock positioned to dump. You could short it and put a stop above its recent high at $21, or you could buy November put options on it. The ones I like traded Friday on a closing price of only $1.95. Now, MXL is another bad semiconductor stock poised to dump. Notice how all these stocks I've been showing you have not been able to rally in the past week. The market went up, it bounced, the market bounced, and these stocks did absolutely nothing. Imagine what they will do when the stock market falls again. These stocks are in trouble. You could bet against MXL by shorting it and placing a stop loss order only 1 point higher from where it's trading at now. You see, when most stocks are trending down in the market, it's best to make money by finding the best stocks to bet against. But I believe what we're facing is not just a drop in August for the stock market, but a new bear market that will really hurt people who are heavily invested in the stock market for the rest of this year and probably well into next year too. You see, what we've been seeing since May with the big drop and disintegration in the internals of the stock market is a type of thing that precedes new bear markets. You see, all financial markets move in cycles. You have a stage 1 basing phase, a stage 2 bull market, a stage 3 topping market, and then a stage 4 bear market. The stage 3 phase acts as a transition period that comes at the very end of a bull market and leads to a devastating bear market decline. During a stage 3 phase, you see the market averages continue to act okay while the internals of the market deteriorate. And this is exactly what we've seen play out in the last month in a big way. We last saw this happen in 2007, and it is happening now. The average bear market lasts 15 months and brings with it a stock market decline of 36%. But you can buy ETFs that go up in value when the stock market drops. All you got to do is know which ETFs to buy and how to use ETFs properly in your portfolio. And then you can also look to buy into the few breakaway sectors and new bull markets that will actually begin as a result of the declining stock market. There are ways to make money out of what is to come, and I believe it can end up making both of us a lot of money. But I am right. It's going to be something else to see. The next couple years are going to be some of the most wild years we've ever seen in the financial markets. And out of it, there will only be a few people that succeed and win, because most people are not going to make the changes they need to make now to start doing well going forward. You see, I believe that July and this month, really this week, is going to turn out to be one of the most important times we will ever see in the financial markets, just as October 2007 was a turning point in March of 2000, and also just as important as the March 2009 turning point was for the upside. All these turning points established new trends that dominated the market for months, and then eventually, as people understood what was going on, took over the news media. But those who adapted and adjusted at the beginning were able to benefit. And that's what I want to help you do as much as I possibly can. I think, if you want to trade those 5 troubled stocks to the downside, I think you can profit doing that. But that's just for the immediate term. That's just for this month.